Hi, it's Doc Severson for the Theonite Report for Thursday, January 19th. Okay, the word of today was SKEW, option SKEW. And actually, it's a symbol, which you can see here is SKEW, and is called the CBOE SKEW Index. And so what we're seeing today was that this is a relatively high value. And if you look over the last couple of years, this is one of the higher values that we've seen over the last couple of years. So with all this volatility that we've seen really since the August of 2015 timeframe, so here's the August of 2015 timeframe. We saw all those sell-offs at the beginning of 2016, and here's the Brexit move that we had in June of 2016, and of course here's the election. Right now, this event is ranking up right with the best of them over the last 2 years. So what is this SKEW index? What does it measure? And what does it really mean to us? Well, since this is a CBOE product, if we go to the CBOE webpage and go into the product description, we can start to see the description of this in significantly greater tail risk. As SKEW rises above 100, the left tail of the S&P 500 distribution acquires more weight, and the probabilities of outlier returns become more significant. Okay, so let's put that into real terms and see what that really means. Now, the first thing I'd like to do with this SKEW, and the reason I have it as a line graph, because it doesn't trade during the day, it's just a single value that shows up, almost like if you were to graph the daily chart on a mutual fund, right? So what I want to do here is I want to compare this versus the S&P 500. I'm going to do add a study here. I'm going to compare this with the old S&P 500 right here. And so what you're going to find is the S&P 500 is the pink chart here. So you should recognize the shape from the last couple of years. And you can see that really the high SKEW values that we had really correlate quite nicely to any subsequent sell-offs or risk events that we've had. So right now, no sell-off to speak of, but the SKEW value right now is pretty much correlated as a major risk event over the last couple of years. Okay, so let's look under the hood and see what this SKEW thing really is. Now, if I go over to the option chain, and if I bring up the SPX, and we go out maybe a month or so, and we look at the options, right now we have a price of about, let's just say, give or take about 22.65. All right, so 22.65 is at the money, and we'll eventually get there. Okay, so 22.65. If we go down about 100 points to about 21.65, we can see that the implied volatility of this, of the puts, is running about almost 15%. Almost 15% at that strike price. Whereas if we go about 100 points above or out of the money to the upside, if we go up here to about 23.65, we're going to see that that's running at about 8.75%, almost 9%. So there's a huge difference between the volatility of the out of the money puts versus the volatility of the out of the money calls. Whereas the average for the chain we're seeing here is about 12, which is still a very low number, but it doesn't give us much detail because it's just a weighted average in here. So the difference between the puts and the calls in terms of the implied volatility means that there's a much higher demand for these out-of-the-money puts, which classifies this coming inauguration as a potential risk event. Maybe it's not just the inauguration, but the actual transfer of power, which is implying that we're going to see increased volatility in the near future. So let's go over to the S&P 500 chart. How could we use something like this? Well, really, the premium selling opportunities for certainly the last 6 months have been very scarce for us. Ever since we've had the Brexit move from here, volatility has absolutely collapsed. Not only implied volatility, we've been running vols that have been in the single digits up to the lower teens lately, and that means that we really can't sell much out of the money with any kind of safety to it. Okay, so really we've been in this volatility desert for several months now, especially as we've seen the election reaction and all of the air has been taken out of the option chain. Well, we're starting to get some of that back, at least to the put side right now. So if we do see any kind of a strong pullback down here, especially one that comes down to what we would consider to be a support level, we may have a very nice opportunity to be able to sell out of the money puts or put spreads depending on the strategy that you want to trade. So if there's one thing that we've learned by watching markets through all these years is that market uptrends do not just drop from the top. They tend to get very volatile first before they release, even if it's just a correction. So we can go back to, if you want to, you can go back to 2007 and see the same thing here. We had a lot of volatility up at the top before it started to release, and the real selling came at the very end. This is very, very typical. The real strong selling comes at the end of a bear, right? So you can see how even in 2000, things got to be very, very volatile first before it started to release lower, and the worst selling came at the very end. The worst selling came at the very end. So even if this market is going to start to transition into a corrective one, what we'll first get is that shot over the bow, which introduces the market back to the concept of realized volatility and some big price movement and some large ATR values, right? By going into more of a big, wide, choppy range, a lot of instability, a lot of what I call shake and bake, before it will start to trend to the downside. Now, I'm not saying that we are expecting it to trend to the downside yet. All I'm saying is that before it does, usually we get that shot over the bow that introduces us to the concept of volatility before it starts to trend down. So it takes a lot of effort to take one of these things and push it to the downside. You usually get a lot of protesting, a lot of very volatile price action before that does happen. So backing up a bit, if we do get a decent move to the downside, I think this will be an excellent sell of premium. We should be able to expect an inflated option chain once again and be able to use this increased skew to our benefit to sell that premium to the downside and be able to get some really far out of the money positions for a decent credit, ones that should have a relative amount of safety, at least in the near term. And so if we get past this weekend and early next week and we do not see anything happen, we do not see any risk events come in, we do not see any kind of exogenous events coming in from left field that nobody expected, then what we should expect to see is the skew value will come collapsing right back down again, and then the opportunity is gone from that. So eventually, we will start to see realized volatility hit the tape once again. I don't think we're going to be able to get into the month of March without seeing that come along, and we need to be poised to pounce on it when we do see it. That is it for today's report. Thanks for listening, folks. We'll see you tomorrow.